On last week's program, we talked about financial structure goals. Now that we know our goals, the next step is your financial plan. If you didn't watch last week's show, I would highly recommend that you do so, especially if you're a member, because you got to be a member to be able to check it out. If you're not a member, go ahead and request a free sample training to the right of this player and learn more about what we do here at EGIA and experience some of the training yourself. Now let's go to Gary Elekes, who will walk us through the steps to building your financial plan.
First off, we're going to do a budget. And we're not going to put the budget away after we do it. Okay? In fact, if you're note-taking and you're thinking about, well, what is this meaning to me, we're going to call that a budget to actual system. So we're going to put that into your software program, or you're going to use a budget to actual manual system. Even today with software that we have, we still look at our metrics in our dashboard using a tool that incorporates information from other areas of the business that aren't software driven. So the budget is a starting place. The actual process of what occurs on a month-to-month basis, that's the departmental income statement right here in number 3. And we're going to want to know how well we perform to budget. So I wanted to sell $1 million. I wanted to make $100,000 of profit, 10%. I sold $1.2 million and I made $200,000. Therefore, I performed better to budget. So my variance is positive. I'm very happy about that. Hopefully, I collected the money, which means I had cash flow, which means I have the happiness t-shirt on. Second area inside of the budget is going to be the cost of goods sold. Cost of goods sold is going to be defined later in segments when we talk about the income statement and what goes into the chart of accounts. But suffice it to say that cost of goods sold is based on the principle that when we have costs associated with each one of these departments, we have very specific metrics. We have KPIs and metrics for every single cost of goods sold. So we know for sure how well or poorly we're performing inside of that individual area. So service parts should not be more than 17% of the service ticket. Service labor should not be more than 22% of the service labor rate, not the total ticket, the labor. We know that. We know the margins in service should be between 60 and 65%. We can't produce a 60 to 65% margin in service without hitting those metrics right here based on material and labor. So if those are out of alignment, this is going to be out of alignment. And if this is out of alignment, we can look at these and see where it's out of alignment and make the course correction. If this is a one-bucket company, that all would be obscured, and we would not know that. Our installation department could be performing really well and covering up those sins. I could still have positive cash flow and still be doing well, but I wouldn't know necessarily that I was bleeding in my service department. I wouldn't necessarily have the information to know that. So what we want is we want a system that tells the company what's going on. So we're going to start with a budget, and then we're going to track that based on what's really happening in the departments, and we're going to use KPIs, key performance indicators, to make sure that we know exactly what we're supposed to be doing. And when we manage the business based on the idea of KPIs with a departmental income statement that was based on a set of goals, we have accountability.